Macroeconomic data matters a lot. This is the culprit of fears on Wall Street for the wild trading week. The stock market opened the new year on an optimistic note and coped well with a lot of worrisome signs. Now investors are losing their patience and regaining the risk of mood. The US dollar is again advancing across the board. The worst scenario by InstaForex analysts came true yesterday, and Wall Street closed with sharp losses due to unexpectedly strong factory inflation data and a decline in weekly unemployment claims. This increased the likelihood of a further Fed's aggressive monetary tightening. As a result of a massive sell-offs of stocks, the benchmark indexes tumbled by more than 1%. The Dow Jones sank by 1.26%. The Nasdaq showed the weakest performance, having lost 1.78% intraday. The S&P 500 dropped by 1.26% to close at 4,090 points. The stock indexes did not regain their footing in the pre-market on Friday. They shed another 0.5 and 0.9% before the opening bell. The S&P 500 is expected to trade between the borders of the 4,020 and 4,110 points. The Nasdaq and the S&P had the worst day in months amid global risk aversion. Stubborn inflation and the resilient labor market were to blame for pessimism. The Labor Department reported the fastest factory inflation in January in the last 7 months. Besides, first-time jobless claims unexpectedly went down last week. It proves that the labor market remains tense. The economic data released this week paints the picture of a persistent inflation and robust economy, despite the Fed's campaign of aggressive rate hikes. In the light of such upbeat data, the US Fed is sure to go ahead with the sharp rate hikes. The central bank is likely to raise the funds rate by 50 basis points, at the time not by 25. Cleveland Fed President Loretta Mester acknowledged raging inflation and advocated for further aggressive tightening for longer than her colleagues wanted at the last meeting. St. Louis President James Bullard said that more rate hikes would ensure a slowdown in inflation, even on the back of a decent economic growth. Investors were also discouraged by corporate news. Tesla shares plunged by 5.7% because the e-car manufacturer reworked 362,000 cars because of self-driving laws that can cause crashes. As a result, traders sold Tesla shares worth $47 billion, which accounts for 1/5 of all transactions with the S&P's stocks. Cisco shares jumped by 5.2% to the highest level in 9 months after the company upgraded its profit forecast for this year. Roku shares leapt by 11% after the streaming video company projected revenue in the first quarter higher than Wall Street estimates. However, all corporate news is overshadowed by the main puzzle, the Fed's agenda. A boom in retail sales, the robust labor market, hot consumer inflation, and the fastest factory inflation in 7 months are widely arguments for the Fed's hikes to resume aggressive rate hikes. Wall Street is aware of such prospects, so market sentiment is turning sour. Analysts share forecast of the tough Fed's agenda. Goldman Sachs now projects 3 more rate hikes by 25 basis points this year in March, May and June, to the peak of a target range between 5.25 and 5.5%. Fed funds futures are moving high in parallel. For the first time, the official funds rate is expected to stand at 5.30%, almost half a percentage point higher than in the forecast in late 2022. The funds rate is expected at 5.12% at the year end. In this context, yields of 2-year treasuries climbed to 4.72% on Friday, a 3-month high, and yields of 10-year treasuries also jumped to a 3-month peak. Investors are flocking to the safe haven assets. The market will hardly dispel risk erosion on Friday, and the Fed's policymakers Michelle Bowman and Thomas Barkin are due to speak tonight. The US dollar is flexing its muscles, having climbed by 0.64% intraday. Its index is now trading at 104.52, the strongest level since mid-January. The instrument settled at this high, and the projected intraday Canada is seen between 104.20 and 104.90. The greenback is advancing across the board. Its index has rebounded by 3.5% from the lows of February. Notably, the US dollar put pressure on its rival currencies despite the hawkish ECB comments, and the dollar-yen pair notched the highest level of the year. At the first policy meeting this year, the Fed decided to moderate the pace of monetary tightening and raised interest rates by 25 basis points to the target range of 4.50 and 4.75%. Since then, the macroeconomic data has confirmed robust hiring and stubborn inflation. This assures the Fed to continue aggressive monetary policy. Export prices in the US grew by 0.8% in January, defying the forecast of a 0.2% decline. It's the first growth in export prices since June 2022. Import prices were in line with the expectations and dipped by 0.2%. The indicator has been sliding for 7 months in a row. Imports prices rose by 0.8% on year in January, the strongest annual growth since December 2022. All in all, a series of upbeat economic data give the Fed enough leverage for further hawkish moves. It means that the US dollar has solid fundamentals to assert its strength. The Canadian dollar is facing a sell-off. The USD CAD pair rose by 0.5% before the opening bell to trade at 1.3520. The intraday Canada is defined between 1.3470 and 1.3540. The loonie had a chance to gain bullish momentum yesterday, thanks to the hawkish rhetoric of the Bank of Canada's officials. Chief McClam said that the domestic economy is overheated and the labor market is too tight, so he signaled more rate hikes in the future. The policymakers confirmed the hawkish stance and acknowledged the influence of the strong employment data in January, released last week. The Canadian economy created 150,000 jobs last month, 10 times as high as expected. At a first glance, this is great news for the Canadian dollar, but the firm US dollar and the considerable fall in oil prices outwined the Bank of Canada. Crude oil slumped by almost 3% on Friday because investors are alarmed about the hawkish Fed. Brent futures sank by 2.8% to trade at $82.76 a barrel, and WTI futures plunged by 3.1%. Both benchmark rates are on track to close the week with a sharp loss of almost 4%. The crypto market is sharing the overall pessimism which hurts risky assets. Bitcoin has plummeted by 4% in the last 24 hours, but recouped some losses later. The token is trading at about $23,800 intraday. Ethereum, Solana, Ripple and Litecoin have been also affected by pessimism. They are trading mixed. The hawkish Fed's agenda is to blame for the doom and gloom in the crypto market. At the same time, investors got to know mixed news on the crypto front. Binance moved more than $400 million from its independent US partner to the firm run by the Binance CEO Dow. In the first 3 months of 2021, more than $400 million were transferred from Binance.US account in Silvergate Bank to Merit Peak, managed by Dow. Interestingly, the U.S. Securities and Exchange Commission launched an investigation into connection between Binance.US, Sigma Chain, and Merit Peak. On the plus side, Dubai passed the legislation to boost the crypto sector because Web3 and the crypto firms are welcome. It proves that demand for cryptocurrency has been rising despite broader economic problems. The outlook for Bitcoin is not as gloomy as it may seem. It's the only crypto which has been classified as an asset by the Securities and Exchange Commission, so the token has an advantage in terms of legal clarity and regulation. Good luck in your trading and see you next week.